Two people walk into the same bank, same house, same neighborhood, same loan amount, same down payment. One walks out paying $2,004 a month. The other walks out paying $2,163 a month. They nod at each other in the parking lot. Neither of them knows what just happened. Over 30 years, that gap costs the second person $57,240 more for the exact same house, same yard, same street. The only difference between them, a 3-digit number, your credit score. And most Americans have no idea what theirs is actually costing them. Your credit score is a number between 300 and 850. The higher, the better. Most people know this. What most people do not know is where they actually stand. The average American FICO score is 715. And if you have a 715, you probably think that is solid. You probably think you are doing fine. And you are fine. But here is the thing about fine. Fine has a price tag. Because the difference between a 620 score and an 800 score is not just a number on a report. It is $400,000 over your lifetime, quietly leaving your wallet month by month, in payments that feel completely normal, because they have always been this way. Let me show you exactly where the money goes. Same $400,000 home, 20% down, 30-year mortgage. With an 800 credit score, your rate is around 6.41%. Monthly payment, $2,004. With a 700 score, your rate jumps to 6.63%. Monthly payment, $2,050. That is $46 more per month. Sounds manageable until you run it out. 30 years and realize you paid $17,000 more for the exact same house. With a 620 score, your rate is 7.15%. Monthly payment, $2,163 over 30 years. $57,240 more than the 800 score buyer. Same house, same bank, same neighborhood. The only variable, your credit score. And the banker who handed both of them their paperwork went home and slept just fine. And that is just the mortgage. Now add cars. Same $35,000 vehicle. 60-month loan. With an 800 score, you pay 4.66% interest. Total interest, $4,300. With a 620 score, you pay 9.50%. Total interest, $9,900. That is $4,800 more on a single car. Over 6 to 8 vehicles in your lifetime. $28,000 to $40,000 gone, just in car loan interest. But here is where it gets truly unfair. In 47 out of 50 states, insurance companies are legally allowed to charge you more based on your credit score, not your driving record. Your credit score. A driver with excellent credit pays $1,673 per year for auto insurance. A driver with poor credit pays $6,254 per year. Same driver, same car, same roads. $4,581 more per year, just for having a lower number. Over 40 years, that is $64,000 in extra premiums. For driving the same roads. Add it all up. Mortgage, $57,000 extra. Car loans over a lifetime, up to $40,000 extra. Insurance premiums, $64,000 extra. Utility deposits. Higher credit card rates. Worse rental options. Researchers put the total lifetime cost of poor credit versus exceptional credit at $397,652, nearly $400,000. That is 9.4 years of the average American salary, quietly bleeding out. Month by month in slightly higher payments that feel completely normal because nobody ever showed you the bill. And here is what makes it worse, that $159 extra you pay every month on your mortgage. If you invested that, instead at 6% annual returns, it compounds to $181,000 over 30 years. The real cost of a bad credit score is not $57,000. It is closer to $250,000 in wealth you never build. Before we fix it, let me destroy 5 myths costing Americans real money right now. Myth 1. You need to carry a balance to build credit. False. Completely false. Pay your full balance every month. The card company loves this myth. You do not have to. Myth 2. Closing old cards is good. Hygiene. Wrong. It reduces your available credit and hurts your score. Leave old cards open. Myth 3. Checking your own. Score hurts it. No, checking. Your own score is a soft inquiry. Zero impact. Check it every week if you want. Myth 4. Your income affects your score. It does not. A $40,000 earner with discipline outscores a $400,000 earner who mismanages debt every single time. Myth 5. 850 is the goal. It is not. Above 800, everything is unlocked. The difference between 832 and 850 is zero, practically speaking. FICO's formula is completely public, and most people have never seen it. Payment history, 35%. This is the biggest factor. One missed payment at a high score can drop you 50 to 80 points instantly. Credit utilization, 30%. This is how much of your available credit you are using. Below 10% is good. Below 7% is exceptional. Length of credit history, 15%. The average 800-plus score holder has maintained their oldest account for 23 years. You cannot shortcut time. Credit mix, 10%. New inquiries, 10%. Here is the critical insight. Payment, history, and utilization together are 65% of your score, and both are things you can control starting today. Everything else, just patience. Getting from 700 to 750 is about elimination, not construction. 3 moves. Move 1. Pay your balance before the statement closing date, not just the due date. This reduces your reported utilization immediately. Move 2. Set up auto pay on every single account. One missed payment at this level is a disaster. Automate it. Remove human error completely. Move 3. Pull your free credit reports from all 3 bureaus at annualcreditreport.com and check for errors. Millions of Americans have inaccurate information dragging their score down right now. Disputing it costs nothing and takes 30 minutes. This phase takes 6 to 12 months. It is not exciting. It is infrastructure. But this is where lenders start treating you differently, and you can actually feel the tier shift in the rates you get quoted. Getting from 750 to 800 is optimization plus patience. Push your credit utilization below 7%. The average among 800-plus score holders is 5.5%. If you only have credit cards, add an installment loan to diversify your credit mix. Stop opening new accounts completely. Let your existing ones age. And here is one counterintuitive detail most people miss. Scoring models reward 1% utilization on one card, slightly more than 0% across all cards. 0 everywhere looks like dormant credit. Leave one card with a tiny balance when the statement closes. This phase takes 1 to 3 years. You cannot rush it. But during this phase, the financial world starts to feel noticeably different. Rate quotes change. Options open up. One last warning. And this might be the most important thing in this entire video. A high credit score is not the same as financial health. When you hit 800, banks offer you enormous loans. Mortgage brokers show you the maximum you qualify for. Card companies send high-limit offers. The system is built to help you borrow more, not to help you decide whether you should. Someone can have a perfect 850 credit score and negative net worth. The score measures how well you manage debt, not whether you have wealth. The goal is not to borrow as much as possible at the best available rates. The goal is to have an 800 score, live below your means, invest aggressively, and occasionally deploy that score to get the best terms on something you have already decided you actually need. The score is the tool. Wealth is the destination. Do not confuse the two. David still has a 714. He is still fine. He just does not know yet what fine costs. Now you do. Your credit score is not a vanity metric. It is financial infrastructure that changes the price of everything you will ever borrow for the rest of your life. Build it carefully. Protect it seriously. Use it deliberately. The best time to start was 10 years ago. The second best time is right now. Subscribe to The Money. Mine for more psychology of money every week. And drop your credit score in the comments. I want to know where you are starting from.